Hi, Gary and Kevin here from Chicago. We have our third quarter Observer update, and we've been waiting for two things to happen this year. The first one occurred in August, and that was a 12% correction in the market, and we like to see a 10% correction now and again. It was 4 years since the last one, so the market has been waiting for that for a long time. The second one hasn't occurred yet, and that was the Federal Reserve raising interest rates. There's a 1 out of 3 chance they're going to do it in December, but I would bet against that. I would think not till next year, as most people think will happen, and there's some of the things the Fed's waiting for. But part of that whole thing, when this correction took place, we saw stocks in various markets going down by various amounts, and there's this whole thing of what's at play there, what's going on, what are people doing, why are they buying certain stocks versus other stocks, Kevin?
Well, we're doing this update on November 3rd, and we've had a recovery since September 30th because that was just coincidentally close to the bottom for the year, and it's a positive that we've seen this recovery because the market was kind of technically fractured. If you looked at the technicals around the end of the third quarter, just wasn't a lot of breadth there, less sellers but no buyers. The rally subsequent to that is going into the safe names, it's going into the mega cap names. It's largely been this narrow focused rally, so you think the market might be fairly valued by most earnings estimates, but you got some areas that are maybe overvalued and other areas that are undervalued. So I like the quote that was in Barron's last week. We kind of need the rest of the troops to catch up with the generals.
Yeah, perfect. What drives the market a lot is earnings, and the interesting thing about earnings is we've had this kind of steady growth, and part of that earnings is all about GDP, the gross domestic product. And worldwide, it's about 3.1% this year, estimated 3.6% next year. And China being a small part of that, only 13%. But we had interesting earnings this year versus last year. What happened with earnings?
So the earnings last year, $117.
Yeah, right.
And this year they're looking to be close to that.
Same, yeah.
But if you take energy and the dollar out of that, you maybe have another $12 of earnings. If the dollar increases and companies have 30 to 40% of their profits from overseas, they translate them into a more expensive dollar. Even though your revenues are higher, your profits are lower.
Exactly.
And energy has had a significant impact as well. I think you combine those two, that's about $12.
Right.
If interest rates, that malaise, kind of that worry about that, if oil has kind of run its course, $45-46, right? Yeah. And the dollar as well, people are thinking that that's maybe run its course. You might have a further rallying here, but especially with raising interest rates, might give more strength to the dollar. If you take that kind of away over the next quarter or two, people start looking at 2016 earnings, $128 versus $117. You can see
we could continue along
at least some positive impetus.
And the last thing is, remember back in the late 90s when they had that big tech rally and everybody was going,
Well, that's similar to now, right? I mean, you get a lot of people running into the names, maybe the safe names.
Well, we didn't. The problem was diversification.
Safe names versus everybody. The only place to be is in the internet, right? But people started concentrating, and at the time, at the bottom of that tech bubble, the place to really be was in the areas that were most undervalued. If you had that foresight, right? Being in emerging markets and in developed international, that element of diversification more than carries you through the next cycle. So it does go periods of underperformance and outperformance. But normally, why do you have diversification? It's not so much because you're trying to hit a home run, is that you want to have some dry powder to buffer your losses in a down market. That's what happens when people forget, when you have a narrow rally. I want to be in that area, but the next cycle, I wish I weren't so concentrated.
Exactly. Yeah. So diversification will have its day in the sun again, coming back. So anyway, this is our update for the quarter, and we wish all of you a very happy holiday season, and
we look forward to Max in the new year, perhaps having a little bit of yield in our money market accounts.
Absolutely. So enjoy.